Welcome to Agency Acquisitions and Exits. I'm your host, Peter Leng, and today we welcome back Dom Hawes. As many of you know, Dom recently stepped down as Group CEO of Selby Anderson, and I'm thrilled to announce he's joined us as one of our programmatic M&A coaches. On this episode, we're unlocking one of the biggest questions business owners face when stepping into M&A. What does it really look like to bring on investors and use other people's money to scale through M&A? We're shining light on that entire journey from the moment you decide to raise capital, what you have to build in your model, and all the ways you have to execute this scaling M&A plan. And there's no better guide than Dom Hawes, who's lived it and is now here to share every insight. Let's dive in. Welcome back to the show.
Well, thank you, Peter. Great to be here.
Okay, before we jump back in, let's get everyone up to speed. Of course, they've heard your first episode if they're listening to this. But what are some of the key attributes and components of your story that led you to building Selby Anderson?
Okay, wow, big question. Okay, so the number one lesson, actually, the kicker, the reason I started it was when I realized that a good deal is about structure, not price. Like the barrier to being able to do deals is often structure. When I realized that, and it was actually through the process of modeling that I really got to understand structures. That was the key thing. So like from what we're going to talk about today, the link is kind of structure because I built that business with the assistance of investors. And the key to getting investment was having a comprehensive model and being able to demonstrate how structure would allow us to create leverage and be able to create arbitrage over time.
Now, we're not going to present on the screen the eyesore that is a financial model, but let's lay it out for the listener, which is there's two ways to raise money. You can raise money from venture capital, and venture capital is typically that pitch deck everyone hears about, and you're going around and circling a concept and idea. And then there's this acquisition funding and financing and getting other people's money to contribute to that. And so this model that you built is a very standard model. Typically, it's designed to be leverage buyout or deployment of investor capital. Walk us through not how you build the model, but the components of it that you started to use from your previous experience doing this, which you had. And then how did you figure out how much money you needed and where to source that investment from?
Yeah, okay. So the key components of the model are every unit. So the mothership, if you like, it depends on how your corporate structure is going to work and how you're going to need a holdco, right? If you're going to integrate everything into one holdco, the model's a bit simpler, but you're still going to need every entity has to have its own sheet. So you model a mini P&L, a mini balance sheet, and a cash flow for every business, like a pro forma one. So the starting point is to create a simplified chart of accounts that allows you to compare business to business. We can come on to that maybe in some detail later. So one sheet for each business, one sheet for the mothership, which basically consolidates and aggregates. You need a very large assumptions sheet, something for your variables that allows you to do some scenario planning. What if interest rates go up? What if growth rates slow? All that kind of stuff. You need lots of what I'd call intermediary sheets. So unless you happen to be a VBA whiz and you can do it all in VBA, and even if you are, it would probably be too complicated. Most people, when they're building these kind of models, they're taking data off a core model, putting it onto a very large sheet that no one ever sees, and then using, index lookups or V lookups or, an Excel formula to then extract that data and put it into a summary that you can see. And then the most important sheet of everything, of course, is the dashboard or summary sheet that goes on the front that looks at what a 5-year plan looks like. And that's driven by the final sheet, which will be your acquisition plan. So when I build these models, I've built several. I would probably I'd allow space for maybe 16 acquisitions. And then you can change the size, you can change the date, and that should ripple through. And you can change the funding mechanism, and you can change the amount of cash down, and you can change the lever period, all that kind of stuff. And that will then trickle through to allow you to model what cash looks like, because cash is king. But also, are you building value as you scale, or are you just scaling something that has no added value? So the benefit of those models are that they allow you to speak to very sophisticated investors about your plan and what your plan actually delivers. Now, there's a caveat in there, of course, which is that some of the assumptions you make are external, they're environmental, and you cannot model all of those. COVID being a good example, Russia's invasion of Ukraine and the impact that had on economies. Yes, world leaders who aren't necessarily 100% rational and can send markets spiking, that you can't model that stuff. So all you can do is model how you think the world is going to, how you think, your business is going to develop if the world remains constant. Now, you can build some external factors in, like if the markets start drying up and stuff, but the really VUCA stuff, if you like, the really volatile stuff, doesn't go in your model.
No, black swan events don't count in the model.
That's the one. That's the word I was looking for. Black swan events.
Yeah, black swan events. You described as some of the assumptions. So unpack the three key scenarios, because there's also various degrees of scenario analysis that you can apply to the future performance of various assets. But what are the three main scenarios you're typically building out in that first version of the model?
I mean, taking timing and acquisition, the number and taking all that stuff aside, assuming that you have a plan, what I would want to take is three cases. My scenarios would be three cases. A base case, which is, this is what I think we're going to achieve. And that base case would be predicated on a certain profile of profitability per unit. Now, you can change that as you start to get more information, but you start with a base assumption, let's say 15% EBITDA as your base assumption. You'd start with a base case growth rate, and you'd want to be probably conservative on that. So you'd say like 10 to 12. And some of this is going to go into your buy box, obviously, and it will help you to decide what you bring in. But for the sake of modeling, you're going to want to make some basic assumptions. And actually, it's an interesting thing about data. If you try and get too granular too quickly, your model becomes less accurate, not more accurate. Yep. So it's fine to take an aggregated rate, because some will do better, some will do worse.
The rule I want to make sure everyone knows is you will be wrong 100% of the time in this model.
That's absolutely true. So you don't want to get too granular too quickly, too smart. So growth rates, profitability rates, and then some assumptions about your fixed overheads. And that will help give you a plan. So, and when you're building a group, you have a bunch of choices that will dictate how much overhead you build. Like, what is the role of the group? If the role of the group, for example, is to drive new business, you need to build a team to do that. Your overhead will increase. So those sorts of assumptions are important. So three cases. The base case, this is what I think we'll deliver. A worst case, like if stuff goes wrong, this is where we think we'll be. And then obviously a best case, which is if everything goes exactly as I've forecasted it, which of course it never does, this is where we'll end up. So
we definitely use that best case though when we're talking to those investors.
Tip number one.
This is an important tip for people.
Tip number one: if you're speaking to investors, don't go too hard on the best case, because that's what they will remember. And when it comes to 2 years down the line, that's the number that's going to be brought out.
Yep,
that's the number they're going to talk about.
Yeah, I use the same naming conventions with slight modifications. It's downside. So I like to actually call it an underperformance of the base case. And then above the base case is the growth case.
Yeah, okay.
And I typically or the base case could be also labeled the management case. Downside is the credit case, all things that set the right expectations for the underwriting.
Yeah.
So you build out this model. So say I'm a business owner today. I don't even have a spreadsheet model for my own company. And what you're describing sounds intense. Help bridge this concept for me, this founder, about, okay, because I have an asset already. And I'm thinking about making that one of the first companies in the model that I can go and then bring on investors to go do more M&A. Help me bridge that.
Okay. So I'm gonna play your advice back to you on this. This is who, not how, right? You probably need to get some help. But look, if you've got your own business and you want to acquire one other business and you want to build a model and then model that out, you get the financial details of the company you're looking to acquire. You build that into a simple one sheet. So the way I used to do it was I'd have a profit and loss at the top, a balance sheet directly underneath that in the columns, because you've got your monthly management accounts or your annual accounts. So you can then do your balance sheet by month to look at how the balances vary over time. And then you've got a cash flow under that. So you build that in to start with, choose your acquisition date, work out what your synergies are likely to be, like what cost savings can you make, and you need to factor that in. And with one sheet and one company, that's really reasonably simple.
Yeah.
Reasonably simple. Like, you don't need big formulae. You don't need loads of toggles and on and off switches to model scenarios. It's quite straightforward.
You don't need a tab for every financial statement per
No.
company.
Keep it.
You keep it very simple.
Keep it really simple. It's really, because if you then say, actually, I am going to do something programmatic, I am going to look at 3 or 4 a year, you're going to want to model 3 years. That's 12 transactions. And if you make the first one really complicated, you're going to end up with spaghetti. So keep it, even if you're just modeling one, keep it really simple, stupid, and actually get something you're comfortable with that you can work. And then when you do go to seek assistance from somebody, say, look, this is my starting point. I need it to be simple. Yep. And then they can build something. I mean, look, any decent finance person, and I'm talking about a proper finance person, will be able to build these models. So, and they'll know how to do it, and they'll know what it is.
Yeah.
But if you're doing it yourself, keep it really simple.
Yeah. If you want to do something casually with high consequence, do it yourself. If you want to do it with high probability of success, hire professionals. And it doesn't cost a lot to have someone help you build out this model. I give a version of the model in a plain English format in my course in the M&A Mastery. And so the only delta shift that I changed from yours is that in my one sheet, I make it more akin to a Q of E, which is I try to teach the discipline. Of contract and customer or client breakdown of revenue from the get-go. Because far too often the chart of accounts don't reflect the business model itself very well. Sometimes these companies started and they use very templated chart of accounts, and they haven't been made to communicate what it is a business actually delivers or provides as value to the marketplace. And so what I typically want is every customer listed out with a start date and end date, and then the actual payments of that customer or that client tracked monthly within the balance sheet, within the P&L. And so I just teach that one little modification because I want you as the buyer to really have a Q of E mindset. So the quality of the contracts and the revenue that's coming in, not just the financial statements.
So I totally get that. So for you, for the program, that's really important because quality is more important than absolute number. If you've got a big number of very poor quality, it's not a good acquisition. So the models I built, where you're doing high velocity work, that's probably too granular, but I get the importance of it. If you're starting like
in the one pager,
totally.
So let's talk about that acceleration now, Dom, because now you've laid the table. It's set. We got all these tabs with a bunch of companies' financial statements. You have, let's call it a dozen acquisitions that you're forecasting as activity. And then you have some assumptions around deal structures, free cash flow, debt service, and back office support and infrastructure. All right, I just have the spreadsheet, Dom. How much money do I need to get to start this, to execute this model?
That depends on the scale of ambition for your acquisitions, obviously. And it depends. I mean, there are lots of variables there. So you don't actually need a huge amount to start doing this. You really don't. A lot less than people think. And then it depends on your plan. So there are basically 3 broad reasons you'd take investment into a plan like this. One is speed, i.e. you want to do lots very, very quickly, and you cannot recycle the new businesses in and turn them into free cash fast enough to basically iterate. So you're going to need to do multiple and finance multiple at once. That's the first one. The second is, so one is speed. The second is scale. You're buying big agencies or bigger agencies because you are going faster and you are trying to get to a particular point of scale. And the third reason that you're going to take investment in like that is to allow you to do better deals because you can be confident about the amount of cash that you can deploy. So it just gives you the confidence to go out after better targets. When I very first started, I was looking at using a small amount of equity and some debt to lever it, but it gets very complicated very quickly. And actually, when I managed to raise the money for this latest venture, the one I've just left, it just gives you a totally different way of going to market, a totally different way. You can speak to multiple agencies at the same time, knowing you can acquire multiples at the same time, et cetera, et cetera, et cetera. Now, it's important to say, whatever you put in your model will not come true. As you said, 100%, the full cost will not work. So it's important when you're building that model to be able to adjust it as you go.
Yeah, it goes back to understanding the component parts and being able to
Yeah.
manipulate them yourself.
Yeah.
You can farm it out to an FD or a CFO
Yeah.
or a controller, but it's very important for you to know that as you make progress on the business plan, whether it be from raising capital or closing that first acquisition, the model needs to always be accurate and up to date.
Yeah, and you need to be able to work it too, right? So it's no good having to go to a CFO and ask them a question. If the model gets too big and too complicated, it takes a week for them to come back with an answer that doesn't really help you move at speed. So you need to be able to work it, and you need to find a way. So one of the ways I did this, actually, I totally get the chart of account argument. So one of the challenges I had when I was looking is I wasn't looking at one class of agency. We're looking at lots of different classes of agency. So we had a matrix as a buyer box. We wanted to be in different disciplines, in different geographies, at different scales, and different agencies report differently. So, and the key there is, it's a bit of an obvious statement, I know. The key is how they handle people costs, right?
Yeah.
So different agencies handle people costs differently. So we just made a hard and fast rule, which I still abide by when it comes to a creative agency where your people are your product, is all people costs go above the gross profit line.
Yep.
And what that allows you then to do is compare any agency like for like. And I only had 5 cost centers in my fixed overhead. Everything would be shoehorned into that. So then I built a model that would allow me to map a supply chart of accounts onto this simplified one, so that within like 10 minutes I can compare agencies side by side, like for like.
Yeah, we call it fixing the financials.
Yeah, exactly. And then once you've done that, you can then look at comparative KPIs across different agencies and work out which are the better deals and which ones aren't.
Yeah. Standard GAAP principles, so generally accounting principles here in the US, require that the labor allocation go to cost of goods sold. But a lot of small businesses and agencies just put that in operating expense.
Well, yeah, they
overhead.
do, or they fudge it, right? So they'll say they're account based, therefore they'll go into cost of sale. These people don't contribute to accounts, therefore they're not, and they'll hide their people in the costs somewhere else. So it's important to take all the people out, because whether they're working on the account or not, the total amount you're paying your people is your number one KPI. It's different subject, different place, but these are the conversations you need to have when you're speaking to investors, because they'll want to understand the single biggest overhead you've got, which is people.
Yeah. I mean, we just talked out of our mouth from both sides by saying, try not to get too granular and complicated.
I know.
And then we just got granular and complicated.
I know. There you go.
But okay, so we've figured out a way to map very standard financials that have some classification issues. So the model is more reflective of the business itself that we're buying. And then you had set the expectation that the investment, the first acquisition, and the size and scale that you want to operate at dictates potentially the funding amount. So let's do an illustration from this and use an example. If let's figure out that the anchor you wanted to buy is north of 1.5 million of EBITDA. So you're going to start not at 2, 3, let's not keep it too far out of reach for too many people, but 1.5 million of EBITDA. You started the conversation with saying structure is the thing that got you really understanding how to do this. Let's go through it.
Okay, so let's give them a 4 times, right? That might be a little bit high for a 1.5, but let's assume they're growing really well, because 4 is an easy number, right?
Yeah, you can get a 25% return on money with that, quite frankly.
Which gives them a 6 million valuation, right?
Yes.
So your enterprise value for this transaction is 6 million. So the first thing is, and the reason I think structure is important. Actually, I don't want to get into negotiation. I was about to go down a rabbit hole again. Let's not go there. Right. So 6 million. Structure is important. So you're going to want to lever that somehow, because you get your value from leverage. My standard when I speak to people is 50% down, 50% deferred.
Yeah, very common.
No, very common. Exactly. Now I know there are more aggressive ways of levering. There are challenges if you put less down. But if you've got a 3-year earnout on a 4 times and you're putting less than 45% down, this business will not cash flow itself over the following 3 years, and you are making yourself a hostage to fortune. Yes. So let's just say 50%. So at 6 million, that means that you need to find 3 million down for that business. Now that's the total consideration is 6, the closing consideration is 3. So then the next thing is to look at how much, and I'm talking UK specifically here, it may be different in your part of the next thing is to look
bridge.
At, you can bridge it. So the next thing I will look at in the structure is how much cash have they got in the business, because they're going to want to take the cash out of the business at close. And unfortunately, there are brokers who will say, well, you can get that out, well, not sort of free. They'll pay it to you when you leave. Well, it's free to them, apart from their tax, the capital gains tax they're paying on the share sale. But it's not free to me when I buy cash. And that's what people often overlook. There's a cost to me buying that cash and then paying it out to them.
Yep.
So I will almost always include cash as part of the total consideration and then pay as much of the closing consideration with that cash as I can. Does that make sense?
Yep.
Okay. So let's just say.
So let's bridge that. Let's just say there's a 1.5 million in profit business. Most likely this is let's give them some credit, a 20% margin business.
Yep.
And so they have a general overhead that, has to be, let's call that four something million in revenue. And they got a lot of overhead costs. So they have how much cash typically? Dom, you looked into it.
Well, it depends how much they've been building over time. I'm going to say this company's got $1 million sitting in its bank accounts in cash,
and that's very common. Yep.
Yeah. Why it's sitting in cash? They should have been using it to buy other businesses, but hey, it's sitting there. It's sitting there in cash.
It helps them sleep better at night. The typical story that we hear from
let's make it even simpler for ourselves. Let's assume that we've already done the working cap calculation.
Yeah, let's do that.
There's $1 million in free cash, right? So they've got $1 million free cash. They want $1 million out. So we said the enterprise value is 6 plus free cash makes total enterprise value 7 million. Yep. So that means that 3.5 is needed at close to pay 50%, of which $1 million is free cash.
Yes.
So I now need to find $1 million for them, which is their own money, plus 2.5 million from external sources.
And then just so the listener can follow where we're going, it's because you're using the cash flow of the business in the earnout.
Yes.
And the debt service to this earnout is what you were describing in regards to not having enough money paid on close. Therefore, we won't be able to use the cash flow to pay down the earnout.
That's exactly it. If you don't pay enough on close, then you're banking on being able to grow the business pretty much from the get-go to deliver more free cash across the earnout period to pay the debt requirement over that. Now, hopefully you're structuring it well and using vendor finance, but you still need to pay it. It's still a debt. And it's a very uncomfortable world if you find yourself in a position where you can't meet your obligations to your vendors.
Yeah.
You don't want to be there.
No, it's a lot easier to actually work with outside investors than to have the covenants and restrictions that outside lenders often put on businesses.
You definitely don't want to take external debt unless you really have a solid model. Because the renegotiating covenants will make you lose your hair. Just saying.
So we have a 2.5 million cash on close payment that we do not have the money on the balance sheet to buy because this is a spreadsheet model. So Dom, let's talk about what happens next.
So you got to raise it. So you got to raise that money. So I mean, this is a hypothetical case, right? So I personally probably would be looking at something that had slightly easier economics than that to fund in the first instance. But if you've got to raise money externally, you've got like 2 or 3 choices. Let's deal with debt because that's the easiest one. We just dealt with that. I would not go out. Unless you have a track record, you will not be able to raise a significant amount of debt unless there is a government supported scheme. Now, I know that there is a government supported scheme in the USA that is popular. There is nothing like that in the United
anywhere
Kingdom.
Anywhere else.
Anywhere else. Yeah, exactly. Yeah. But it still comes at a price, and you still have covenants, and it still has. I'm assuming they'll still be taking
reporting requirements,
the business, and all that kind of stuff. Yeah. So let's assume that debt is off the table. You've got to go work with investors. So you're either going to model out 4 or 5 transactions and say, right, this is my total cash requirement to do all 5, and go and find an investor to bankroll the build, or you can go and do the first one and then go back to market once you've proved you've got a track record. Or, and I've seen people try to do this at the moment, you try to do each deal piece by piece and bring different investors in for different pieces. Now that's possible.
More investors isn't more better.
No, no. There are some benefits to taking that
Yeah,
approach. Largely control, right? So
mainly
if you've
control.
got,
Yeah,
yeah, mainly control. So, but then you've got a challenge because every investor comes in wanting an exit at some stage. And the
yeah.
more investors you have, the more exits you've got to run. Then you find yourself trying to run a secondary market and all sorts of other things. It's really, really
Well,
painful.
the common statement is a $25,000 check takes the same amount of time and energy as that $1 million
Yeah,
check. And
yeah.
so you can do it through piecemeal, and larger numbers increases the investor relations complexity quite a bit.
I'd also probably go further than that. Actually, and I found this the hard way. I mean, I've raised money for several different ventures. If the amount you're looking for is too small, it's actually harder to find than if the number is slightly bigger. Because you're either into VC territory where it's a small bet, they make lots of small bets, but they want exponential returns, and you have to have an infinitely scalable model. This is not that. This is people-based. Or you are relying so much on being able to deliver organic growth that it's just like, why would they put the money here? It's like there are so many other places to put money. So my advice is, if you're looking to invest or get investors, is to look to raise a decent amount of money. So my starting point last time I went out looking, my starting point was 500,000, but my sweet spot was probably more 1.5. But I was buying agencies smaller than this, right? So I started with small agencies, and we got bigger as we went. But to get that money, you're going to need a model. You're going to need a pitch deck, just like you would with a VC. You're going to need to explain what the business is about. You're going to need an operating plan. How are you going to find them? How are you going to negotiate them? How are you going to fund them? How are you going to integrate them? How long is the payback on each investment? What kind of controls are you putting in place? So there's a lot of thinking that goes into raising the money, all of which, by the way, is identical to the process you go through if you're going to buy them, right? So if someone's taken your course and they know exactly how they're going to run programmatic acquisition, exactly the same information is what the investors are going to want to know if they're going to back a business. Exactly the same.
So we have a $2.5 million or pound sterling payment to our illustrative sellers. We talk about raising money for this. Let's say there's a variety of different sources, from small boutique private equity and family offices. What has been your experience now that we have all that material prepared? We have the model, we have a business plan, we have an operating company, and we have a target that we want to buy with agreed upon terms.
Okay. So small cap private equity will back individuals with a model and a plan. They're not very common, but I've seen it. I've been approached by a few, not personally to run them, but people who have that kind of model and are looking to buy bits and pieces. So they will, but it's only really if someone's done it before, or they're taking someone out of a very large company and saying, we're going to back you to do this. Like, we're backing the jockey, not the horse, right? We know you can do this.
And they're also going to run the playbook with you too,
most
of the time.
Because they've got the whole structure there. They've got an origination team, a negotiating team, a deal team. What they need is someone competent to run the business. That's a different thing. So they come with a load of infrastructure. Down from there, let's say former PE houses. Under that, you've got a bunch of family offices. Family offices are also in the private equity space these days, but they tend not to have the same infrastructure. So you would need to prove to the family office that you have the capability to originate, acquire, negotiate, integrate, and they will often work to a smaller ticket size than private equity. Yep. But the economics of how the deal is done will probably be very similar. It's going to be very hard to keep a majority of the business that you are starting at the close of an investment round. You're probably going to want to be negotiating some kind of a ratchet or an earn back in as you prove yourself over time.
Yep. You work for whomever gives you money.
Yeah, exactly.
If from proof, you can earn back into a degree of equity position, distributions. You can also negotiate a loss of control, but a little bit more acceleration and initial dividends or distributions. There's a lot of ways to get there.
Yeah. So I mean, most investors, if they're putting a decent amount of money down, will want some kind of, you've got to have a formal investment committee, and they'll want to be able to veto deals because it's their money being deployed. And I've looked at, do you run an LPGP model? So do you actually structure yourself a little bit like a private equity fund would be, where you are operating the company day to day, they're owning the assets. I mean, there are lots of different ways of structuring these kind of deals to allow yourself to scale quickly and de-risk it from an investor point of view. It depends on the appetite of the individual investors. So we've done PE, then there's family offices. Family offices generally tend to be thinking longer term than PE houses because they don't work in closed-end funds. They're managing their own money. So they can be more patient capital, which can be beneficial, particularly in volatile markets. And then under them, you've got kind of angels and high net worths or ultra high net worths who either may have made their money and exited, but want to invest back in the same sector and or not. So for single deals or search funds, those might work reasonably well.
Yeah, we label those in the U.S. accredited investors.
Okay.
And
yeah.
One of the recommendations I give to most people when they're trying to get investment on a current business and scaling and growing is who you just referenced. It's very helpful to go to someone who's exited in the industry. So they understand the industry. They've gotten paid. They've had their successful exit, and then they're redeploying capital. Yeah. And so they can also be an advisor. They can add things beyond the capital. They can add introductions. They've built a version of the business that you're looking to build. They're great in that journey with you. Okay, so we've laid the table with the potential funding sources. For this type of deal, what we're describing, Dom, who are you going to go with?
I'm going to go to family. Well, if I'm going to go that big as my first deal, and I'm assuming that I've got a track record, and I think I can find more of that scale, I'm going to go to a boutique private equity house, and I'm going to see if I can get them to back me.
Would you recommend this operator find more than just the first deal before?
Yeah, yes, definitely, because they want to see you can get pipeline. So definitely. So you want one that you can close quite quickly after funding. And then you want another 2 or 3 with who you're in an advanced stage of conversation with.
Yep.
That will materially improve your chances of raising money.
Yeah. And you've probably already included them in the model. They're also included. They're included as acquisition targets within the deck. And so there's an immediate game plan when the go button is pressed. So So investors know, and you have your work to do. This also goes into your assumptions around the management of those businesses. So your back office or the responsibilities of the holdco could be a little bit more explicit versus kind of vague and unclear, because you have clarity, hopefully, to the complexity of this now 3 to 4 asset portfolio, and therefore your model can be a little bit more accurate.
If you've done your planning well, for example, if you've been through your course and you've looked at your integration strategy, you can model out the back office stuff really easily. And then you've got a plan, so you just need to stick to it.
Yep. And also try not to have costs expand with asset expansion, which happens quite quickly when people are running this model. They go, oh, the back office now is going to take over finance and accounting services. We're going to take over tax obligation. We're going to consolidate so much, and we're going to centralize. And now the back office has to have enough free cash flow or additional investment to support its assets. Maybe talk about the difference between centralized and decentralized and how you think about it.
Yeah. So, I mean, I think it depends on the value proposition you're trying to build. So to simplify, centralized. Okay, so the ultimate centralized is you're building one brand. So when you're buying, they're losing their brand, they're becoming part of you, you're building one model. There are lots of pluses and minuses in each case, which is the subject, I'm sure, of a totally separate podcast. But that's the ultimate centralized. The ultimate decentralized is they keep their brand and they keep everyone. So you are not trying to seek any synergies in back office costs. Now, the easiest way, certainly to begin with, is to find somewhere halfway between those two poles.
Yep.
There are massive issues, particularly if you're levering your acquisitions. There are massive issues with you not having control over finance at unit level. Huge issues, particularly if you've got performance-related earnouts.
Yeah.
So you definitely want to have control over the policies, accounting policies, and they want to be consistent. So this is, I think I called it club rules when I was doing it. Everybody needs to agree to what the club rules are before the acquisition completes, and they know that within the first week of integration, a migration is going to start to the new way of doing things. The problem with centralizing everything, if you have a centralizing back office, if you have a decentralized model, is, as you say, you're building separate headcount. That headcount needs management. The management needs management. And you start building this thing that's only got one way of growing, and that's up. So So in the early days, I would keep it as simple as possible. I would create as little disruption, personally, as little disruption to the unit as possible to start with. So I would centralize policy and I would centralize the consolidation, but I would probably keep service delivered locally until everything's bedded in, and then you can make a managed transition to a more central model when you understand what the true requirements are. And a lot of that will depend on your investors as well. So different investors have different reporting requirements on their own investments. Some want really detailed reports, which equals a lot of accounting time. Some don't, which equals a much simpler life. So while, when you close your fund, you want to deploy as fast as possible, and suddenly lots of stuff is going to start happening. So I would personally only be doing the things you need to be doing.
Yeah, critical items being centralized mainly for the prudent administration of the assets.
Yeah, control. I mean, it's about governance. It's just a good governance thing to do. Yeah.
And then another frame of mind is integration. So let's say within your model, you've had a dozen acquisitions forecasted. You started the fund with 4 identified, 1 anchor that your initial capital is being deployed to, and then shortly thereafter, the rest. There will be a time when merging 2 assets is part of the thesis, or combining them more than just cross-selling. How do you think of that in the model, Dom? When they're like, hey, they're actually doing things better than us. Can we do it like them? And they're actually asking you for this integration, for this merging of effort.
So merging, this is just my view, right? I know there are a lot of people who probably do it very successfully. Merging 2 units often makes more sense on paper and in a spreadsheet than it does in reality. It depends whether you've done a capability or a capacity acquisition, right? If you're acquiring capacity, merge it, that's fine. But if you're trying to bring 2 capabilities together, 2 management teams together, firstly, there's going to be some attrition, and you've got to work out who that is. And secondly, it's a very difficult change for human beings to deal with. And so you need a very considered plan, and I would suggest a lot of advisory in how you make it work, because otherwise 1 + 1 ends up equaling 1.5. My experience also is that when you merge 2 units, immediately post-merger, you see a fall in performance. But a short while after that, it then comes and picks back up. And so you need to be warning and advising your investors that when you do this, it is not a short-term gain. It's going to be short-term pain, but over the medium to long term, you'll realize that gain if you do it well.
Yeah, it's a J curve. Oftentimes people are modeling conservative, meaning no impact. In the first year, you actually have to model a downside performance. But then because of the synergy between the compatible assets, and after you kind of shake loose whomever is going to stick around, the businesses typically can continue to perform beyond the independent assets on their own. And so you just have to model it, and you have to set the right expectation for your investors and your leadership team.
Yeah, I was going to say, from a leadership point of view, that I think it's one of the more challenging things in life, doing that. It's a very difficult thing to do well and make work. So, when I've tried it in the past, I've made sure there are really good advisors around, and even then it hasn't always worked. I think particularly, as I said, if you're trying to bring 2 capabilities together to create a new value proposition, to go out and try and find advantage, that takes a lot of time, effort, work, input, everything else. I'm not saying it shouldn't be done. I'm just saying tread carefully before doing it, because often it looks easy on paper, but it's really hard in reality.
Yeah, it's akin to climbing Everest. We only see the photos from people who are at base camp or at the peak. There's a whole journey that got them to base camp. There's a lot of work that goes into it, and it can be extremely fruitful. Another point of advice that I want to double tap in the model is the timeline, the horizon by which you measure significantly impacts your returns. If your measurement is marginal, meaning 1 or 2 years, M&A can be very disruptive. But over a 10-year, 20-year vision or model, you can then shake out the business beyond the earnouts, beyond the debt service. And it's a completely different animal than if you're measuring within the period of your M&A and earnouts.
Yeah. And that, this is an important consideration when taking external investment. If you know your investors have a timeline of 5 years, for example, and then they want an exit, you need to front load your activity, because they're not going to be wanting to deploy capital in years 3, 4, and 5 because they won't want the overhead associated with it. And they're going to want to be through as much of the earnout, get the debt down as much as possible so that they can maximize their return on the exit.
Yeah.
So you need to think about the rhythm of your acquisitions across, if you've got a fixed term or ideally a fixed term investment, let's say a 5-year cycle.
I want to talk about this merger of people component because we are very fortunate to be in people heavy industry. We're not dealing with that much machinery and widgets. What I typically advise people is your acquisition team, whether it be through outside advisors or the people you ultimately bring on board in the mothership, the back office, the holdco. You need to have the personalities that support people. And oftentimes the people who are starting these ventures are the ambitious, high D, if we're referencing DISC, financial spreadsheet folks, strategist people. And the last thing they want to do is get pulled into all the human drama of all this. And so my recommendation in regards to the people you need around you, which is what I want to just cover as our next subject here, you got to have someone who is the high EQ, the person who is the HR, the person who cares and listens to the complaints of the people who are going through a messy situation. That's what M&A is. It's just a big mess with the assumption of increased value at the end of it. And if you don't have that person as a part of your back office or as an external HR person with experience with M&A, you're going to have a lot of casualties. And then you also need the operational people who don't get, let's just say, intimidated by the size and scale of really large messes. Businesses are messy. People are involved. And so you're the deal person. Have someone who cares about the people around. Have an HR person. Have someone who's your head of integrations, someone who can organize the disorganized and really hold akin the project that is M&A. Those are the two that most people overlook because they're starting as the sponsor, they're starting as the founder, and they bring in finance first. And they bring in the spreadsheet people first. And they're the ones dictating a lot of what's happening in the business of the change that needs to happen. Who else, Dom, do you typically want to have as a part of your advisory team, your acquisition team?
Well, an external advisor, someone who's done it before, is always, I think, essential if you're undertaking something like this. An external advisor, because you assume that, there's an assumption that two agency leaders can get together and work it out amongst themselves. As you've already said, without a really good high EQ HR superstar, you're massively increasing the chances of failure. Without an ops person who can start looking at harmonizing systems and working out new operating procedures, you're maximizing risk of failure. There needs to be a leader who can gel the teams and bring them on the journey together. Somebody who totally gets the vision of the new merged entity and is communicating frequently, whether that's town halls or scrums or weekly cadence meetings or whatever it is, but there needs to be a champion inside the organization. And that doesn't necessarily have to be one of the leaders of the units coming together. Also, we don't want to forget the customer communication, the client communication. This is a big event that's going on. It has to make sense to clients too. So we probably want to think about how we get that value prop out to clients as quickly as possible, because ultimately you're probably looking for some upsell, cross-sell. You've got a customer, you're selling to that, you're bringing a new capability in, you want to be cross-selling that capability. So having somebody to think very clearly and to be able to go through go through the customer list. Like, are they a yes or no? Are they a yes or no? Let's focus our effort. Because the quicker you can get a win, the better. And if people see it, they'll rally behind it. If they don't see it, they'll just stay in their two teams thinking, well, this is a bit of shit, isn't it?
Yeah. When you hear a lot of people talk about acquisition teams or A teams, a lot of it is lawyers, the CFO, the sponsors, and the people who can make this geometric growth a reality. Fundamentally, the people who drive and create value are going to be the people who know the name of the person who works for your client. Like, who's the actual point of
Yep.
contact? They care about that person. That's value creation is in the compounding of retention of those accounts. There's a few cases where you're just wiping them out and keeping the people, maybe, but the vast majority of it is you got to keep the revenue, you got to keep the customer. So you need someone who cares about the customer stakeholder, and then you also need the people who care about the employee and the team stakeholders, the people who, and they have to have those people as their number one consideration. They can't be you, the CEO, the founder, your back office team who, yes, you care about them, but you have other responsibilities to your investors and your external stakeholders. The job of a CEO running this playbook is to interact with external stakeholders. That would be your investors, your lenders, and the market that you're looking to acquire. And secondarily is the operating business. So you need to have people who prioritize them. And so when we talk about like the MVP of a holdco or a mothership, those are the key people that I always, when I see it, I'm very confident in their ability to be successful. I'm also recommending it when I don't see it present. And at the beginning, that's a lot of cost to be burdened on the holdco if you haven't aggregated enough free cash flow. I get that. And so one of the ways that you want to make sure you're doing is have people who are just advisory roles to begin before you bring them on as specific employees or team members of the mothership. And so your point, Dom, this is one of the things that I'm so excited about, is I knew about non-exec and board advisory, but a lot of founders don't. And to your point, it's a lot easier to have someone who's done it before over your shoulder as you're doing it, not to take away the growth and the execution from you, but to see around the corner and tell you who, not how, and what questions to ask when you get to that stage. And it's mission critical. Anything
Well, the
you
other
want to
thing
add
I'd say, look, having been there and done it many times, like phone a friend, right? If you've got a decent advisor to the board that you can just, as the CEO, you can just pick up the phone and say, look, I've got this situation going on. I need some advice. That stuff's invaluable. Like you don't want to be in a situation where you're trying to do something that's very difficult, I don't think, without somebody who has been there, done it, you can trust them, who wants only the best for you in the business to ask advice of.
and your investors want that too.
Yes, of course they do. But of course, investors are expert in investing, not necessarily running. Now, we mentioned earlier about the kind of investors that you counsel people to take. You've exited the industry. You're now investing back into it. That's as smart money gets. That's a really good opportunity. If you've got one of those investors, then they may be able to provide your advisory. Yep. But if you've got professional investors, then they're expert in investing, not in running creative people businesses. And creative businesses are very idiosyncratic. Anyone who runs an agency knows that they are fragile beasts. They need to be treated carefully.
And Dom, you've come full circle in the journey. Now, you're in a position where you're helping others on this exact path that we walk them through. Yep. You and I have been talking for, I think it's been over a year now. It's easily over a year.
It is almost a year. Yeah.
And watching the impact of not just content, but the direct intervention impact from your counsel on founders has been amazing. And so, like, you've joined as a part of our coaching team. Welcome aboard.
I have. Thank you very much. I'm really excited, and I'm learning loads again. You see, like look, if you're watching this, I've done the course, and even though I've done this professionally for a living, I learned loads on it. It's really good. It's really good quality. I'm delighted to be a member.
And you're not only going to support founders one-on-one in their programmatic M&A efforts, helping them buy growth and create these models and create the type of financial impact that they want for their business and their families. You're also going to be a constant education resource. Like, one of the reasons I got so motivated to start this type of the podcast and the resources is they weren't available to me. And you were in the same boat. You and I had to reinvent the wheel on our own through our own journeys time and time again. And yes, we were stealing from our experiences, stealing from others in the space in regards to M&A and leveraging that to execute a plan. But there wasn't one that spoke directly to our archetype and the special snowflakes that exist for a business that is so creative, so technology oriented, and really people forward. So I greatly appreciate your resource and value that you give to the community. It speaks so highly of you.
Great. Well, no, the other thing I think is really exciting, and I'm looking forward to coming to my first one of the events, because when you're running one of these things, it can be a bit of a lonely business. So to be able to get amongst peers, other people who are doing the same thing, like I didn't have that. I went out and sought it. I went out and found people who were doing similar things, But in this small market, we were a bit competitive. But to be able to get in the room with other people who were doing the same thing and share ideas, you can't buy that stuff. You can't buy it.
It compresses time and has geometric impact on it.
Massively. Yeah.
Well, Dom, now when people go to find you online, they don't go to Selby Anderson. Where are we directing them to connect with you?
Well, they can connect to me on LinkedIn. That's an easy place to find me, Dom Hawes, or on hunterhawes.com, which is my new business website. But yeah, LinkedIn is the easiest place probably. I'm sure we can put a link in the show notes. Connect to me, chat to me. It'd be great to meet.
Yeah, and leave a comment the next thing you want Dom and I to unpack. I got so excited about having this episode. And Dom is a wealth of knowledge. We've just scratched the surface. Absolutely just scratched the surface. We didn't have, I think you and I said we could do like a 3-hour Joe Rogan style podcast easily on this.
It's hard not going down those rabbit holes, isn't it? Because everywhere you look, there's more detail. But yeah.
And join us if you're listening to this and coming to any of our live events. Dom and other coaches are there, and you can work directly with them in person. You can have those peers side by side, and then you have the ability to work directly with Dom as a board advisor, the exact people that Dom and I have hired throughout our careers to compress time and make the thing that we want to happen a reality. So Dom, I appreciate you, my friend. Thank you.
Thank you very much, Peter. Yeah, thank you.
If you like this episode, probably like one of our other episodes. Click here.